Welcome to Sustainability Bridges, a EuroSIF podcast that aims to build bridges between policymakers, investors, academics and civil society around the theme of sustainable investment. EuroSIF, the European Sustainable Investment Forum, is the leading pan-European association promoting sustainable finance and investment at the European level. In these podcasts, EuroSIF's Executive Director invites distinguished guests for a 30-minute conversation on current events shaping the sustainable investment community.
Hello, ladies and gentlemen. My name is Aleksandra Palinska and I am the Executive Director of EuroSIF. For this episode of Sustainability Bridges, I am delighted to welcome Marco Zwick and Shaneera Rasqué from the Commission de Surveillance du Secteur Financier, CSSF, the Financial Supervisory Authority in Luxembourg. Marco is the director of the CSSF since 2018, and Shaneera is head of regulatory projects and sustainable finance. Today, we will discuss sustainable finance from a supervisor's perspective, why it matters, and how supervision can support investors and other financial market participants. We will explore what the latest regulatory developments in the EU, especially the review of the Sustainable Finance Disclosure Regulation, known as SFDR, and the Omnibus Simplification package, mean for transparency. We will also dive deeper into the ESMA's Common Supervisory Action on Sustainability Risks and Disclosures. Thank you very much for joining us today. Marco, to start, for the listeners who may not yet know the CSSF and its responsibilities, could you please provide us with an overview of your work and the SSF remit?
Yeah, thank you very much, Aleksandra, and hello to everybody, and thanks for the interest in the CSSF. So first of all, I would just say we are a public institution in Luxembourg. We act as the Luxembourg's supervisory authority for the financial sector. And this means that the CSSF supervises professionals and products. And if I take the fund industry, this would cover in particular investment fund managers and also the investment funds themselves. And we cover all supervised entities generally of the financial sector, with the exception of the insurance sector. So you see that the CSSF has a quite broad remit. And if I would just speak about the two key missions which I see for the CSSF, it would first of all be depositor or investor protection, and secondly, the monitoring of the financial stability of the market. So in pursuing the objectives, the CSSF applies a prudential approach in line with international standards, European regulations and the Luxembourg regulatory framework. And we implement for that purpose a risk-based approach to verify that the authorized entities are complying with the regulations which are applicable to them. In that sense, the CSSF also cooperates with the European supervisory authorities, which you probably all know under the acronyms EBA, ESMA and IOPA, and also other supervisory authorities at the European and international level. And I would just say that the CSSF is a very active member in international fora such as IOSCO and also the Network for Greening the Financial System.
CSSF has been very vocal that integrating sustainable finance into supervisory responsibilities is a priority. Marco, could you explain why it is so important for you and what it concretely entails for your work?
With pleasure. So first of all, I think we recognize that sustainable finance addresses the fact that the European Union needs to invest sizable amounts until 2030 and probably beyond to address the global challenge of climate change and to support the green transition. And we also think that it is very important that there is a mobilization of private assets as a complement to public financing. And if we look into the strategic foresight report published by the European Commission in 2023, the European Commission has estimated that there is a total amount of about 620 billion euros, which is needed on an annual basis. In consideration of its significant size, the Luxembourg financial sector has a key role to play in this area. And one condition to have a strong financial center is also to have a strong financial regulator and supervisory authority. And with that, also to have a robust supervisory framework, which allows to enhance investor trust. And I think that's something which comes back to our basic mission of investor protection. The CSSF has thus integrated sustainable finance into its supervisory responsibilities, aligning its supervision with the requirements of the European regulatory framework, and in particular with the requirements of the ESMA supervisory briefing on sustainability risk and disclosures in the area of asset management. Now, ESMA had in that briefing defined a number of key areas, and let me just take those which I find the most relevant. First of all, the organizational arrangements of investment fund managers, which need to integrate sustainability risks into their framework. Then there is the verification of the compliance of pre-contractual and periodic disclosures. There is also the verification of the consistency of information in fund documentation and marketing material, as there is also the verification of compliance of product website disclosures. So this is all about disclosures, but there is one point I wanted to add, which is key to our mission. It's not just to look at what has been written and what has been committed, but it's also to look at what has been delivered. So we are, of course, also investing time and money to look into portfolio analysis and to do also the review from our perspective. So it's not sufficient just to have the rules in place, but it's also to have the analysis at fund management level and also at the level of regulators. For this, actually, the CSSF has adopted a risk-based approach. And there are three main pillars of that approach. First of all, the authorization of investment fund managers, the authorization of investment products, the compliance with SFDR amendments, which need to be embedded into the new CSSF e-identification procedure for prospectuses. Secondly, we invest a lot of time in our off-site supervision after we have authorized a product. For that, we would review periodic disclosures and the organizational arrangements of Luxembourg asset managers. And then there is the third level, which is on-site inspections. That's where, based on our risk assessment, we would visit companies to see what is really happening on the ground. So the CSSF has also, as part of its mission, tried to accompany the implementation of the sustainability-related requirements by conducting a dedicated thematic review in 2023 and participating also in the ESMA Common Supervisory Action on sustainability risks and disclosures. We have published reports after this. We have also published questions and answers, Q&As on SFDR to provide greater guidance to professionals and to provide also more clarification about certain rules.
Thank you, Marco. That is very interesting. Looking back over the past years, how would you describe the evolution of sustainable finance? What role does the EU Sustainable Finance Framework play in this development?
Well, over the past years, we know that sustainable finance has evolved to be a central pillar of finance, which is actually good news. And we also think that the real turning point in all this began around 2015 with the adoption of the UN Agenda for Sustainable Development, including also the Sustainable Development Goals, the objectives, which we all know, and also with the Paris Agreement on climate change. So we consider this to have been a good starting point. And since then, concrete climate targets have been set, and it became clear that financial flows should be redirected towards sustainable projects to achieve this climate goal. The European Union has played an important role in this transformation. First of all, in 2018, the European Commission launched its action plan on financing sustainable growth. Secondly, this led to the EU Sustainable Finance Toolbox with regulations which we all know under the names of SFDR, EU Taxonomy Regulation, CSRD, and also MiFID II Sustainability Preferences. These frameworks have set standards across European markets, effectively raising the bar. Europe's fund industry saw a significant shift of assets into ESG-oriented funds. And if we take the figures going back to the second quarter 2025, we can conclude that the combined assets in Article 8 and 9 funds of SFDR represent over 59% of the EU fund market. So it shows the success and the positive evolution in that sense. Finally, the CSSF will use all its means which it has at its disposal from a supervisory authority perspective to contribute to the achievement of these objectives within the framework of its own missions that notably consist in ensuring the safety and soundness of the financial sector in the public interest.
I will now turn into questions on the review of the Sustainable Finance Disclosure Regulation, and also maybe even actually looking a little bit back at the origins of this regulation. I will turn to Shaneera in a moment, but before I do so, Marco, would you like also to share some views or insights on the review of this very important regulation?
No, I would leave it to Shaneera. I think obviously it is a key point for the CSF also to acknowledge that there may have been issues with SFDR 1. And we also find it is really showing a lot of courage from the European Commission to recognize and to go public with some of the amendments which are needed to provide clarity to a very important product. And so from that perspective, we wholeheartedly support this process of review.
Great. Thank you so much, Marco. So turning over to you, Shaneera, SFDR is indeed one of the key EU sustainable finance regulations, and it aims at improving transparency with regards to sustainability considerations in financial markets, including financial products. From your perspective, how have the objectives and disclosures of funds in Luxembourg evolved since the SFDR has been applying as of 2021?
Hello, everyone, and thank you for having us today. I'll start by saying that SFDR has been a game changer since its entry into force in March 2021. It brought transparency to sustainability considerations and kind of pushed market participants to expand and strengthen sustainability-related products. It really marked a turning point by putting sustainability into the spotlight. Now, in Luxembourg, the impact has been particularly significant, and this is due to the size of the financial sector as a whole, and also the importance of the asset management industry. Luxembourg remains today the leading ESG fund domicile by assets under management in the EU. Now, on the question of knowing of how disclosures have evolved, I must say that the implementation of SFDR has been complex. The rollout of disclosures has been a bumpy road for market participants and for NCAs in their supervision. There are several reasons to that. The first one is that Level 1 text lacked clarity on core concepts of a framework, like the definition of sustainable investments, how to compute the proportion of sustainable investments or the treatment of derivatives. When Level 2 text entered into force in January 2023, it added further complexity with very detailed pre-contractual and periodic disclosures and also interpretative challenges. For example, taxonomy disclosures and the inclusion of sovereign bonds or not. They also included heavy data requirements, while ESG data, or I must say reliable ESG data, was often missing. This led the European Commission and the ESAs to issue extensive guidance on the application of SFDR. This guidance was needed, but it also had major practical implications. First of all, clarification of Level 1 text via Q&As have important implications on enforcement powers of national competent authorities. Several of those clarifications triggered intensive discussions with industry participants on the implementation, while other clarifications had immediate market impact, notably on Article 9 products. In July 2021, the European Commission clarified in an FAQ that Article 9 products must invest only in sustainable investments. This resulted in a wave of reclassifications, and hundreds of funds across Europe, including in Luxembourg, moved from Article 9 to Article 8. Overall, this was a healthy and necessary adjustment, also demonstrating a strong regulatory compliance. Now, where do we stand today? The implementation of SFDR has been a learning journey for both market participants and supervisors. The CSSF actively supported this transition through communiques and FAQs, a thematic review on sustainability disclosure and asset management, and regular communication via webinars and conferences. In 2025, ESMA also conducted a common supervisory action on sustainability risk and disclosure in the asset management area. This exercise concluded to a satisfactory level of compliance with the applicable provisions. There are still weaknesses, and those include disclosures that are hard to locate, especially on websites, or vague or unclear language. Part of observation stem from a framework that still lack clarity. Looking ahead, a positive development is that the European Commission acknowledged these shortcomings. A revised SFDR was published at the end of 2025 with objectives of improving clarity, enhancing quality of disclosures, and achieving greater simplicity for investors. So we strongly believe that the revised SFDR is a key step towards a more usable and effective disclosure regime.
Thank you so much, Shaneera. As mentioned, the SFDR is currently under review. On 20th of November last year, the European Commission has published a proposal which is now being negotiated by the EU member states and the European Parliament. What are your views on the Commission's proposal? What do you think are the key elements to ensure that this review results in fit-for-purpose rules?
I'll start by saying that the CSSF strongly supports the ongoing work at EU level on the SFDR review. After 4 years of experience, we now have a necessary insight to improve the framework. We all know that testing the framework has revealed several weaknesses. For example, disclosures are complex, some foundational concepts lack clarity, SFDR has been used as a labeling regime. These weaknesses, of course, limit the effectiveness of SFDR for market participants, but also for investors. Thus, addressing those shortcomings is really key to achieving a fully functioning SFDR. At the CSSF, our priorities are to focus on greater simplicity, clearer disclosures, and putting investor needs first. On this last point, I want to mention that SFDR was meant and is still meant to be a disclosure regulation. So what should it achieve? It should allow to bridge the gap between investors seeking green investment opportunities and the real economy's financing needs. A sine qua non condition to this is to have information that is clear, simple, and understandable for investors so they can make an informed decision of the investment that is being proposed to them. In parallel, we need to ensure that the foundational concepts of SFDR are clearly articulated to support a consistent implementation by market participants and also to promote supervisory convergence across national competent authorities. Now, regarding SFDR 2.0, the CSSF considers that the overall direction of travel is positive. We strongly support having product categories underpinned by minimum objective criteria and simplified disclosure templates. SFDR 2.0 also acknowledges the ESG data challenge and provides guidance on the use of data and estimates. We particularly welcome the alignment with the ESMA guidelines on fund names because it limits potential market disruption for asset managers. That said, there are still difficulties and they lie in the details. Assessing level 1 without level 2 is very challenging. And this is relevant in the present case as several key concepts introduced at level 1 require further clarification at level 2. I can quote the underlying principles of an appropriate transition plan or the definition of an impact theory. In addition, there are still elements which remain unclear in the proposals, and others do not appear to us to be operationally workable. For example, we do not support identifying non-categorized products based on the volume of sustainability claims in pre-contractual documents. We believe that a more effective investor-oriented solution would be to align with the ESA's opinion on SFDR, which has been, by the way, thoroughly discussed with NCAs, and which require a disclaimer stating that the product is not categorized under SFDR. This will also result in a more efficient allocation of supervisory resources. From a supervisory perspective, there are also elements in the proposal which remain unclear at this stage, like the reference to the replication or management of PAB and CTB indices, the catch-all provision for eligible investments under Article 7 and 9, and last but not least, are the expectations regarding the composition of a remaining portfolio, that is the 30% proportion. And there are still open questions that persist on the treatment of derivatives and the application of exclusion to derivative positions. On this last point, I want to stress that asset managers have highlighted operational burdens in applying exclusion to index derivatives that are used for hedging and efficient portfolio management techniques. This is a constraint that benchmark administrators do not face today, which kind of demonstrates that exclusions under the benchmark regulation cannot be directly transposed to the fund industry. So we need to make sure that there are further adjustments that are being applied to how exclusions are being rolled out, and they are needed to ensure a fully functioning SFDR 2.0. The CSSF will continue contributing actively at European level to achieve a clearer, simpler, and more effective SFDR framework.
As part of its simplification agenda, the European Commission has launched a series of so-called Omnibus initiatives. Omnibus I, adopted last year, has modified several of the EU sustainable finance rules, including the Corporate Sustainability Reporting Directive and its accompanying European Sustainability Reporting Standards, the EU Taxonomy, and the Corporate Sustainability Due Diligence Directive. One of the main outcomes has been the reduction by around 90% of the in-scope companies captured by sustainability reporting. Other big changes include the removal of an obligation for the largest companies to set and implement climate transition plans. What is your view on the final Omnibus agreement and its impact on investors, companies, sustainable finance, and your supervisory activities?
The Omnibus initiative introduces substantial changes to the sustainability regulatory landscape. We all know that the revised rules apply to a smaller set of companies and ease certain obligations for firms. This is very much aligned with the European Commission's objectives of simplification and burden reduction. What does that mean for us? It means that narrowing the scope of sustainability reporting entities creates new challenges regarding the availability of ESG data, and in particular for the quantitative disclosures required under the SFDR. So if we look ahead, there are two potential approaches that could help address this huge data gap. The first one is reducing the extent of quantitative disclosures under SFDR, and the second one would be to allow the use of estimates, provided that appropriate safeguards are in place. If we look at SFDR 2.0, it appears to move in the direction of allowing the use of estimates. There are explicit requirements on the use of data and estimates in the proposal, and the fact that the rules are embedded directly in the Level 1 text is something that we particularly welcome from a supervisory perspective.
Last year, the European Securities and Markets Authority, ESMA, the EU's financial markets regulator and supervisor, led a common supervisory action on sustainability risks. What does that mean for SSF?
Common supervisory actions are a key tool in ESMA's supervisory toolkit. Their objective is to promote supervisory convergence, and they are an in-depth assessment of how fund managers implement the applicable regulatory framework. It is important to note that CSAs are carried out by national competent authorities based on a commonly agreed EU framework. So the involvement of NCAs is really key because we have a deep knowledge of their local markets and they possess the technical expertise to assess the developments in their jurisdictions. It is quite evident that the close connections NCAs have to their local market is a key element to supporting EU's competitiveness. So the CSSF is very supportive of CSAs, especially when they contribute to greater supervisory convergence and allow to foster consistent application of EU rules across member states. If we look at the conclusions of the CSAs, at the CSSF and regarding the Luxembourg market, they align with the ESMA findings. Financial market participants demonstrate a satisfactory level of compliance with the applicable sustainability-related provisions. We published in September 2025 a feedback report, and we also issued some recommendations for improvements, notably in relation to the quality and accessibility of disclosures, funds names, communication of sustainability credentials, and the integration of sustainability risk into risk management frameworks. While the ESMA CSA report also reflects these observations, it also identifies areas where supervisory convergence is still lacking at EU level. For example, there's still uncertainty on the basis for calculating the proportion of sustainable investments. The treatment of derivatives under SFDR is a key topic. The expected level of granularity for disclosures, and also importantly, the delineation between Article 6 and Article 8 products, which might also be an issue under SFDR 2.0. So those are still important questions that need to be solved. We know that SFDR is currently under review, introducing potentially significant changes, and we also need to be cautious about implementing new rules. But at the same time, it remains essential to ensure that the framework is workable during the interim period and that investor protections remains our priority.
As we reach the end of the podcast, how do you see sustainable finance evolving from a supervisory perspective? And is there one key message you would like investment professionals listening today to take away?
Looking ahead, sustainable finance regulation has already started and will continue to evolve. So will supervision. But the CSSF will continue to accompany the transition of the financial sector and financial market participants in a proactive way. The European Commission has recognized the need to amend the sustainable finance regulatory framework, notably in an objective of simplification and burden reduction. And you mentioned the Omnibus package as one example, for instance, simplifying CSRD that has recently been approved by the European Parliament in December 2025. And the European Commission proposed in November a set of amendments to SFDR addressing existing shortcomings in the framework. The CSSF will continue to actively participate in the EU, but also in other international fora, to help shape the upcoming regulatory framework while ensuring compliance of supervised entities and products with applicable requirements. Investment professionals are expected to stay closely attuned to regulatory and market developments at both EU and international level, ensuring they remain prepared for evolving supervisory expectations and able to adapt their strategies with confidence.
Marco and Shaneera, thank you both for joining us today and for this insightful conversation.